So we now count over 4,000 passionate investors at Dividend Stocks Rock. Every time I run a survey asking them what's their number one struggle is, they always answer by telling me it's either I have a problem with buying stocks or I have a problem with selling stocks in my portfolio. In other words, they are stuck in paralysis by analysis. And I totally get that. It's overwhelming. You get tons of information, you look at your portfolio, there are graphs, there are lines, there are stocks, maybe ETF. And at one point, you're just like, you know what? I'm just going to wait a little and I'm not going to do anything and I'm going to let the market go. Actually, that could be a catastrophic idea because maybe you have some losers in your portfolio that are just about to cut their dividend and crash the party. So today, I will offer you a yearly review in 4 simple steps that you can actually review your portfolio and invest with conviction. So each year during the holidays, I review my portfolio. I do that during that time because everyone is asleep and then I can wake up early and then have some calm time to focus on my portfolio. I do those simple steps simply because it makes my life easier and then it makes it so easy to follow my investment rules. So step number 1 is I look at my asset allocation. The asset allocation is super important because it will explain most of your returns, regardless if you are invested in stocks or in GICs or in bonds or in cash. Well, it's going to tell you the story why you did perform well or why you lost money. So on my side, I want to have most of my money invested in equities because I want to participate in the stock market and make more money over time. To review my investment, I use the SR Pro dashboard where I can combine all my portfolios into one single global view. So in that global view, I will look at my asset allocation and well, as you see it, 95% of my portfolio is fully invested in equities. I have a little bit of cash right now, and I'll explain you why, because it's not in my habit to have 3% in cash in my portfolio. And then the ETF of 2% is just a side project that I'm working on. See what's going to happen with this one. So the asset allocation is not just about equities versus bonds versus cash. It's also about where you invest your money. So as a Canadian, I would like to maintain a balance between 50% in Canadian stocks and 50% in US stocks. Why? Well, it's quite simple. The US market is the largest one in the world. It also opens the door to a lot more diversification. For example, if I want to invest in a retailer in Canada, I will go for Canadian Tire. I mean, can you really compare Canadian Tire to Walmart and Costco in the US? Not really. A lot of companies in the US have also international exposure, which saves me a lot of time. So I don't have to look into European market or Asian market. I can just invest in American companies making business across the world. Finally, there are sectors that are nearly impossible for Canadians to invest in if they want to stay in their country. The technology sector is a great example where you can find amazing businesses such as Microsoft and Apple, where on the Canadian side, it's pretty hard to find any dividend growers. In fact, I made an exception with Constellation Software, but for Constellation Software, it's not really a dividend payer with a 20% or 0.15% yield, and it doesn't grow its dividend either, yet it is an amazing business. Now, the last step in the allocation review is the sector allocation. Why is it so important? Because most financial crises will start with a specific sector and then you'll have a domino effect. Imagine that you were mostly invested in the NASDAQ in 2000. Well, it took you like a good 15 years to recover, while if you were diversified across many sectors, it took you a few years, but still after 5 years, you were still in positive. As you can see for my sector allocation, I have 23% in financials and another 23% in technology for almost half of my portfolio. That makes sense because I used to work as a private banker and I run a technology-based company. So those two sectors, I know them well. I understand what they will have as an impact and I feel confident in them. They could be completely different for you, and that's great because there are opportunities in all sectors. The key is to touch a little bit of everything and not have a huge sector where you put all your money in, where if there is any crisis in that specific industry, your portfolio is going to take a huge hit. Finally, I love to use this graph as well that is part of the DSR Pro dashboard where I can see what are my biggest stocks per sector. So as you can see, I have only one position in the healthcare sector chapter, and it's Le Maître Vasculaire. I told you on this channel several times, so if you have missed it, don't forget to subscribe and like this channel so you can see the next videos that are coming up. The advantage of this graph is I can quickly hover my mouse over all the bars and see exactly where my stocks are. So now that I've reviewed my allocation, I went through the portfolio asset allocation, the dollar allocation, and the sector allocation. But there is something missing. Well, of course, it is the stock allocation. That comes into step number 2. What stock allocation means? Well, it is the solution if you have too many companies in your portfolio and you don't know where to start by cutting some of those. I know it gets overwhelming, especially if you manage 50, 60, 70 stocks. At one point, you just have like companies in your portfolio. You don't even know why. You just read about it somewhere, you heard about it, and then you just bought it, and then you're just like, yeah, maybe it's going well, maybe it's not. So what I did is I have set specific rules to help me manage my portfolio. Rule number 1 is I start with my exposure to risk. So I will pull out my top 10 position, and then I will review them one by one. The other thing that I will do is I will ensure that none of them exceed 10%. On this chart that you can see, right now I have 10% exactly invested in Apple, which means that I will have likely to trim a little bit of this one to reallocate more money into my lower position. Why is it so important? Well, imagine that I am wrong on Apple. Right now I have 10% of my portfolio that is exposed to that risk. If Apple crash and burns, this means that I could lose 5, 6, 7% of my portfolio just because I made one wrong pick. So I want to smoother that, but at the same time, I want to let my winners run. Therefore, Apple is going to be trimmed to a 9 or 8% weight in my portfolio, not more than that, and I will let it ride. I did that already 3 times with Apple, and it's great because I was able to reallocate this money into other companies while maintaining a great diversification. I also do the opposite where I'm going to look at my smallest position, because here's the thing. If I have a stock that shows 0.22% of my portfolio, it could double, it could triple. I will not even realize that, because if it's up by 0.46%, well, I mean, that's not going to move the needle in my portfolio, right? So personally, I prefer to have companies that had an impact on my return. Therefore, I want to manage about 30 to 35 positions. So roughly the ideal weight would be about 3%. So for each stock that is below 1%, I just ask myself, do I like this company enough or not to bring it back to 3%? If the answer is yes, well, therefore, I just use the proceed from Apple, for example, and then I increase that position. If the answer is no, I sell and then I move on. I don't spend time figuring out if this is a great company or not. Anyways, it's 0.22% of my portfolio. It's not going to have an impact regardless if I keep it or I sell it at 0.22. So I might as well take a real action and decide to increase the position or get rid of it altogether. So now that I have done the global view part, it's time to take a look at individual stocks. Fortunately, I don't have like 55 companies to follow. And the other thing is DSR Pro is generating a quarterly report telling me what's going on for each companies in their latest quarter. So I read those quarterly and then I take some mental notes. At the end of this year, I came to the conclusion that it was time for me to sell Texas Instruments. So what I do when I review a specific company is I review my investment thesis, so the reason why I love a company and why I purchased it, and the dividend triangle. So if you look at the dividend triangle for Texas Instrument, you will notice 2 things. This company is cyclical. We have a down cycle in 2016 to 2017, another one between 2019 and 2021, and we are currently into the 3rd down cycle right now. So yes, it is a semiconductor company that is highly cyclical, which is normal. What bugs me then is while revenue and earnings are going down, the stock price kept on rising in 2024, making the investment in Texas Instrument not making much sense. So since I was a bit overweight into my technology sector, and on top of that, I could have a very solid price for Texas Instrument. The investment thesis of a analog company making a lot of money selling chips for industrial and automotive industry is still good, but as revenue and earnings decline, I was have expected to see the stock price going down. Now it's going up. I decided to sell. I cashed a great profit, and then I will move on. So as you can see, I don't give much value to the stock performance over a short period of time, but rather I look at the dividend triangle. When the numbers are not backing up my thesis, in this case, all the numbers are pointing down while the thesis is still positive, well, it's the time to let it go and find a company that will show a strong dividend triangle, so a uptrend for revenue, earnings, and dividend, and also an interesting investment thesis. If you want to learn more about how I manage my portfolio and my investment philosophy, I invite you to download the Dividend Income for Life guide. The link is dividendstocksrock.com/income. In this guide, I explain you my philosophy. I explain you how the dividend triangle play a major role in how I determine how to invest in stocks. And I even provide you with a retirement portfolio example that you can take a look at and see how you could create your own on your side. During my portfolio review, I reviewed all my allocations, so asset, cash, and also sector. Then I reviewed the stock allocation, making sure that I'm not overweight in one stock and that all my positions are contributing to my returns. Finally, I did a stock review for companies that shows weaker ratings or will also show a weaker dividend triangle, take a bit of a move. And finally, the last step is to look at my performance. To be clear, I don't want to chase yield. And when I look at my portfolio over a year, I'm just going to take that performance with a grain of salt. Being great over 1 year is usually luck. If I look at the stock market right now, well, the Canadian market is up 24%, the US market is up 28%. In other words, if you are losing money this year, that's not looking good. Where am I standing at? I'm standing at 26 right now. So right in the middle between the Canadian and the US market. What does it tell me? Absolutely nothing. It just tells me that this year was great on the market. It was great in my portfolio, so I can just smile and be happy. What's really important for me is to be able to match the market year over year for a long period of time. So for my pension plan account, I started investing in 2017. I cannot add capital on this one, so calculating the total return is quite easy. I just look at today's balance versus when I started investing in 2017, and boom, I have my return. So the Canadian market during that period of time between September of 2017 and December of 2024 is up 114%. The US market up 174%, of course, driven by Magnificent 7. What about me? Well, I'm up at 178. To be fully honest, if I was even at 150, I would be super happy because I love to be in control of my investment and I love to understand what's going on in each of those companies. So there's a part of me that love the control. There's another part of me that found managing my portfolio as a hobby. And as long as I don't destroy value by managing my portfolio, I'm going to continue to go with individual stocks. Another solution, if you don't have the time, you don't have the interest, and you certainly are not able to manage your portfolio with stocks, you could definitely go for ETF, and that is a great solution for a lot of investors. But for those who love to have the control and are a bit unsure about how to do that, well, this is why I created Dividend Stocks Rock. So Dividend Stocks Rocks is a complete platform helping you investing with conviction. So you will find stock analysis, you will find a newsletter, I do webinars, and you will also have a DSR Pro dashboard where it's going to help you manage your portfolio, identify your weakness, and get rid of those as soon as possible. So with a clear strategy and simple rules like I've outlined in this video, you can see how it is easy to review your portfolio, take action, and then move on with your life. So now is the perfect time for you to review your portfolio, making sure that you have healthy companies for 2025. A lot of uncertainties are coming up, a lot of risks are coming up, and it's just super important that you feel strong and confident with your investment. All right, guys, that's enough for today. I'll see you in the comment. In the meantime, do not forget to like and subscribe to this channel to not miss the next video on next Thursday. And until then, don't forget to stay invested.